Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance, and welcome to our webinar, Generating Sustainable Yield in Digital Asset Portfolios. Unlike stocks and bonds, and indeed real estate, cryptocurrencies do not generate income through dividends or interest payments or rent. Investors have held them for capital appreciation, with their value driven primarily by the ebb and flow of money in and out of the asset class. On the other hand, cryptocurrencies have always generated income. The first Bitcoin miners were paid way back in January 2009, just 2 or 3 months after Satoshi published his famous paper in October 2008. But mining, of course, was not an option for most cryptocurrency investors. It was the Ethereum transition to proof of stake from around 2015 that democratized income from cryptocurrency. And now, a decade on, we have a relatively mature cryptocurrency ecosystem generating yield not just through staking, but through lending. Since MakerDAO in 2014, and especially since the DeFi summer of 2018, when Compound and Uniswap both launched, we've had a distinct decentralized finance system made up of lending protocols, liquidity pools, DEXs, automated market makers, and that's emerged to generate income regularly. Total value locked in DeFi this morning was around $74 billion. More importantly, for our discussion today, institutional money has been coming into the cryptocurrency markets. Access through regulated investment vehicles such as exchange-traded products rather than direct ownership has made that a lot easier. And a lot of those institutions want income, not just capital appreciation. So the question we're discussing today, how can institutions generate sustainable yields on their holdings of cryptocurrency without taking undue risks, is highly topical, as the large number of registrations for this webinar indicates. To help us explore it, we're joined by 4 experts in the field: a banker who offers cryptocurrency custody and staking services, a blockchain infrastructure that provides a scalable cryptocurrency yield engine for advisors to institutional money, and 2 cryptocurrency asset managers. Pavel Jakovlev is head of product innovation and growth at AMINA Bank, a crypto bank regulated by FINMA, the Swiss Financial Market Supervisory Authority. Artemiy Parshakov is Vice President, Strategic Solutions at P2P.org, a staking as a business blockchain infrastructure that supports more than $10 billion in staked assets on behalf of institutional clients. Dillet is Head of Financial Institutions Europe at Bitwise Asset Management, the asset manager that specializes in exchange-traded products linked to crypto assets held in custody. Perkins is CEO at 250 Digital Asset Management, the spin-out of Coin Fund Liquid Strategies, which recently agreed to be acquired by Franklin Templeton, one of that handful of global asset managers with an institutional crypto strategy, and creators of the Benji technology platform. Christopher will be the incoming head of crypto when that deal closes. In addition to our panelists, we do, of course, also have you, our audience, and all 5 of us encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of the Zoom screen. Rest assured, I will not be saving questions and comments up to the end, but will endeavour to encourage our panelists to answer them as we go along, so you can and should be an integral part of this discussion right from the outset. To some extent, of course, you've already been part of this discussion because when you registered, you completed our multiple choice questionnaire. And I'm going to share with you what you collectively told us during the course of this webinar, starting with the first question, which was, are you currently staking or lending cryptocurrencies or stablecoin? As you can see, 2 out of 3 of you are not, maybe not yet, staking or lending. 1 in 5 of you is staking only. 1 in 10 of you is both staking and lending. In other words, there's still plenty of room to engage more of our audience in income generating activities. So that's a very good starting point, I think. And Pavel, you're head of growth at AMINA Bank. What should those members of our audience who are not doing so already be doing to seek an income from their holdings of cryptocurrency? Why should they do that? I mean, they clearly understand the capital appreciation from crypto. What's the case for them seeking income as well? And you can touch on the risk, but we'd like to talk in detail about the risks a bit later. Why should they start seeking an income on their holdings? What's the case for it?
Thanks so much, Dominic, and thank you for the kind words. And major thanks to you and to Wendy and the Future of Finance for organizing this. And it's great graphics. It's also gives me a tiny little bit more insights in terms of who the audience is, and I think maybe I would love to peel another layer behind this and to understand neither staking nor lending bit. Is that because there are already these folks are already holders of the assets and they're just got into it and are not necessarily that comfortable with doing staking, or lending, or they haven't even touched the assets itself. I think this is something that I'd love to understand. And then in terms of how to maybe take the next step, right? Is yes, let's say I have assets, and then potentially I'd like to generate additional income on those assets. I think everything starts with researching the topic. There are many ways how you can approach this. There are ways in how to approach this in a more centralized environment, which we at AMINA have, and alongside some of the other players and centralized exchanges and such, as well as you can do it as a self custody in a self custodial way. So effectively, you have access to different staking and lending platforms. On the lending side, it's obviously Morpho and Aave. And then on staking, I have to give a shout to our friends and partners at P2P. They have a self custodial widget as well. So potentially you can, as a user, you can already engage with their platform today. And then to me, repeating myself again, I think it's all about understanding what is it exactly that you want to do. What are the different infrastructure providers are out there, and then how much of that risk tolerance do you have, right? We have to be careful with digital assets in general. I think our friends and partners, Chris and Ray, and their companies have done a lot of work in creating systems around digital assets that de-risk a lot of that initial topics that came with it back in 2018, 2019, 2020, and 21. And the access through different venues is much better. Yet, the price fluctuation, system outages, all of these different things, they're still there, right? And before getting involved with digital assets, I think it's important for folks to really understand what is it that they're holding, how can they interact with it, and then how do you potentially increase your holdings.
Well, that's why they've attended our webinar today. I hope to start to understand why they should be doing it. I don't know whether it's a question for Artemiy or for Ray or Chris, but is the case for getting involved in income generation with your cryptocurrency holdings, is this true of every type of cryptocurrency holder, or is it true of only some of them? Should some people just steer clear of this? Is it possible to categorize who should be doing this and who shouldn't be? Artemiy, can you give us a
Yeah,
view on that?
of course. Yeah. Following up on Pavel's answer, I believe that you should understand, first of all, your risk profile and goal. If you are a long-term holder of crypto, and it's definitely worth like start generating some yield on it because of like in the first place capital appreciation, right? And doing research is a great first step. So if you're a long-term holder, you want to stay in crypto for an extended period of time, and you want to generate yield, if you do some research on what's like the safest way, of course, the first ladder is staking, because of course, staking bears some risks, even self-custodial, but it's in most of the cases it's a non-custodial, so you hold your keys, and the main risks of losing your assets is slashing, which is a rare case, particularly in industry-wide. It's a rare case, particularly at P2P. We didn't have slashing event over eight years already, so it's almost non-existent if you work with a reputable staking provider. When it comes to DeFi participation, the risks are broader. Of course, there is like low risk DeFi used to be, at least before the recent events this spring. But with lending and DeFi participation, the risks are more versatile, starting from smart contract risk, then off-chain hacks, which is as we see.
Artemiy, you're getting a bit ahead of ourselves here. I think what you're saying is not everyone should be doing this. They need to understand what the risks of different types of yield generating activity are. But just we'll come on to that straight away.
Okay.
The difference between staking and lending and so on.
Yeah. Can I, Dominic? Am I okay to jump in here? Because just to round it out slightly.
You are okay to jump in here, but can you also give us jump in, but can you also give us a sense of what sort of yield people should be expecting here? Back in 2018, we were expecting 20,000%. Now we'd be grateful for 5 or 10%, I imagine, but perhaps you can give us a sense of that as well. But do jump in response to what Artemiy and Pavel were saying.
Yeah, so firstly, Dominic and Wendy, thank you for putting this on, and Pavel and Artemiy, really, really helpful to get your views on this. I mean, just to give an additional bit of background, so within Bitwise, we're known in the ETF, ETP space, but we also cover the active, the funds. One of the certain largest drivers and engines within the business is our on-chain solutions, where we've acquired a test in Chorus One, so providing the staking and technology for the public ones being BlackRock's Ethereum ETF uses us for staking. So does the Ethereum Foundation uses our technology, as do some of the largest, Ethereum treasury companies and a number of other exchanges. And I think to your question of who's this right for? Well, ultimately, are you looking for total return? That's, are you just looking for that passive asset to hold, take the price appreciation or otherwise, or do you want that total return and yield? Then it is, as Artemiy said, well, what's your mandate? As an institutional investor, and as this is institutionalizing, what is your mandate? And when that sits, it's what's your liquidity needs, what's your risk appetite, and ultimately, what's your operational sophistication? And that suddenly makes things different. And we're seeing the more sophisticated groups that are coming are starting to understand this. And obviously, as the larger, more sophisticated groups come in, this goes straight to your question, Dominic, of the 20,000% return to the 2.7, 2.8% on Ethereum today. Quite a divergence, but when you're looking total return and you're looking at sophisticated players, that 2.7 is suddenly interesting. And that could go, I don't know, 2 to 6, 8 is probably standard on a lot of the larger, most liquid tokens out there. Obviously, you can start doing more sophisticated looping strategies around this, but it comes down to complexity and what you do next. But yeah, these are certainly compressed as the market's matured. And I think that's right. And I think that's a sensible sort of next step in the maturity and growth of this asset class.
And can people benchmark those returns? You're describing that 2.7%?
Yeah, absolutely. So let me step back a little bit. Investors want to stay along the efficient frontier. And, to do so, you have to understand what the opportunity is and the risks. The risk-free rate of Ethereum, as Ray mentioned, is around 2.7, 2.8% right now. The benchmark that we use is something called Caesar. I have a company, we invented the risk-free rate. It's a benchmark that administers it. That's actually a very compelling real yield when you look at it through an inflationary lens, and that's just for Ethereum. You can actually have benchmarks for all the other, many of the other proof of stake protocols. So it makes sense. Like as an investor, you don't want to leave that yield on the table. I was very critical of some of the early ETFs because why would you ever have a non-yielding asset when yield is available? The question is, what is the risks that we're going to get into? And I think many of the trusted intermediaries on the phone here, they provide services that help people mitigate some of those risks. Investors often want to have a throat to choke. They want to hold somebody accountable in case something goes south. And they will also pay for market risk all day long. They're very uncomfortable taking regulatory risk, and that's been an issue in the past. I think we're past that right now. They're very uncomfortable taking some of the other risks that we'll unpack. But that's why many investors will decide to use an intermediary. But the beauty of this technology is that you don't have to. You can go into it yourself.
Okay, let's get into where these yields are generated. What Artemiy was starting to talk about, and both you, Chris, and Ray have touched on this as well. basically you can stake your crypto, or you can lend your crypto, or of course you can lend stable coins as well. So we just talk about staking to start with. There, you lock your crypto into this proof of stake mechanism, and you wait to get paid. Is that staking business, you both brought up Ethereum, is that staking business heavily concentrated with Ethereum? Artemiy, perhaps you'd like to address that first.
Yeah, it is concentrated with the Ethereum, but not solely with Ethereum. Like Solana is also a big market for staking, and I would mention Hyperliquid as it's a big growing ecosystem. Yeah, and since the alt season never came, like the rest of the staking market is way lower now. So it is dominated, but not solely by Ethereum. Solana and Hyperliquid are big staking ecosystems as well.
But maybe to double down on what Artemiy is saying, I think we'll see the resurgence of. I mean, Canton is already here. It's a slightly different setup, right? It's a proof of authority, so you don't necessarily need to lock up any capital for stake. It's more geared towards you adding value to the overall ecosystem, so building on Canton, originating transactions and things like that. And then Circle is coming out with Arc. I think mainnet, Artemiy, keep me honest here, I think within the next few weeks or months. So it's similar type of approach, right? So I think it's proof of authority and then potentially moving into proof of stake. I think we'll see more of these TradFi or traditional finance focused chains that potentially would even go away from the traditional proof of stake type models that we're so accustomed to.
Is there a relationship here between risk and reward? I'm interested. Artemiy brings up Solana and Ethereum, who are comparable in a way in terms of their wider strategic ambitions. But you do have some of these protocols yielding higher sums than others. And is that risk reward ratio easily measured? And can it be a useful guide to your staking decisions? Chris?
Yeah. So you do have to factor in risk and reward. What are the risks? Well, first off, what's the reward? And you can look at the various benchmarks to see what the yield is. I think it's important to consider tokenomics and look at inflation in the context. So just don't get obsessed with the nominal yield. Ensure you understand the real yield as well. Very, very important. And these protocols act very differently. As you start looking at the risks, there are numerous risks out there, which could include something like a slashing. You can take market risk. The yield can go up and down. There are now derivatives where you can swap out fixed for floating, and these are very traditional products there. But as you get into the operational risks, the cyber risks, these are all things that need to be considered. And there's insurance that can help mitigate from things such as slashing risk. You can actually even insure the yield now as well. And so very, very many different components that go into it. Each protocol is slightly nuanced, slightly different. But at the end of the day, it's important to understand real yield and then underlying slashing opportunities. And to Artemiy's point, like very rarely do we see slashing thus far. But it's a new risk. Investors need to get their heads around it. But there are plenty of tools to mitigate it.
Okay, we'll come back to risk in a minute. We've had a question from a member of the audience here who asks, one of the big questions around staking lending is if they hold for large volumes. Markets tend to arb away these dislocations. Like, so you might get excited about that 2.7% on Ethereum, but does it hold for a big investment as opposed to a small one? I don't know what your experience, Ray. Chris has talked to you about that.
Yeah, I mean, my view here is the market is incredibly deep and growing at a rate that is, I can't throw out the word exponential, but as you start seeing, let's say, a 2.7, 2.8 on Ethereum, why is this compressed over time? Well, because the market has expanded. Do I think it could compress further? Potentially. And to Chris's point, you need to be thinking, well, I don't know, what are the protocol sort of risks that sit with this? What is the actual amount being staked? What is the unbonding window that comes out of this? And when larger groups, I mean, I was speaking literally just earlier to one of the GSIBs, a globally systemically important bank, who are going to be, well, who are already staking, actually, should I say, not going to be. We're speaking to them about something there, and they are talking about scale and very large scale. And when they're looking at this, why they might not be going down, the liquidity profile of some of the different, whether it's, I don't know, Cardano or Polkadot or whatever, they're looking at Ethereum because they're tokenizing products on this. They are using stable coins that are on this. They understand, they have a deep, deep grasp of the largest, most liquid. So I think there is almost a push and pull that comes here with the rewards are there in size for the deepest, most liquid. Yes, you can get higher rewards, but if you're a large player, you can't be sitting in that space anyway. And obviously, as the market grows and matures and liquidity starts, cascading down, to some of these, smaller chains, then obviously this can grow. But I think that's just
If
a
I could,
natural.
I mean, there's an
if I
obvious
could,
question to ask here, which is about diversification. I mean, are there enough of these proof of stake protocols out there for people to achieve diversification? I mean,
I think it's
are enough protocols being covered?
I think it's important to just maybe take a little more detail on what drives the rate. And if you go into Ethereum and you talk about scale, there's two factors that drive the rate. Number one is the number of validators. So the more people that stake, the lower the return. That's a bad thing. But the other component to the yield is the priority transaction fees. And what does this mean? It means the busier that the network gets, the more yield that you see. And which makes these rates so interesting is that many times they're negatively correlated to traditional rates. So if there's an idiosyncratic factor in the Ethereum ecosystem and people are trading like crazy, like for example, when we saw issues with a USDC and SVB, counterparty risk, everyone wanted to move their assets into Tether. You saw so much transactional activity, the rate went through the roof. So those are the components, and many of the other protocols act similarly. So it's very, very important to understand that, to your point, Dominic, there's idiosyncratic impact of some of these rates. If you have a massive amount of activity in one or the other, generally that tends to increase the staking rate.
And that's a brilliant element on the sophisticated side of that question. On the more simple vanilla, if I jump in there, diversification doesn't just come through, I don't know, a broad range of different tokens. It can come through diversification of geography, custody, liquidity, validators. Right, you've already said validators, Chris. But yeah, lots of different dimensions that come in.
Should we talk about lending now? How do you do it? How should our audience go about that? Basically, you can go to an exchange or you can stick your crypto into a DeFi app. Are there other options? And if whether there are or not, how should people distinguish between routes to market for lending their cryptocurrency?
We should take that one if nobody wants to throw themselves at it. Yeah.
Yes, go ahead, Pavel. Yeah.
I mean, look, there are two ways, right? And I think we need to just make the case for both, the centralized approach and the decentralized approach. So effectively, if you're doing your, I'd say, more on the borrowing side, if you have crypto assets and then potentially you're not too keen on selling in the market, in the down market, then you're like, well, actually, I'd like to keep my Bitcoin, but at the same time, I'd like to get some cash for it. Then you can apply for a loan, right? That loan is usually issued, or at least with us, in fiat, but there are other platforms, centralized platforms that do that in stables as well. And then you keep, you keep doing that over a certain period of time, specific terms, and then you're looking at more likely a fixed rate, right? You come to a credit desk, you lock in the rate, you lock in the loan to value, repayment, all of these different things, and then you just keep going for as long as needed. In an up market, potentially you would have a situation, or at least some of the tendencies that we see, some of the user behavior that we see is that folks still continue the borrowing, but then instead of potentially spending, they just buy more of the asset that they're borrowing against, right? And that just effectively compounds. if you do go through Morpho or Aave or some of the other protocols, or Spark for that matter, you're fully self-custodial, right? You're obviously exposed to additional risks, smart contract risks to be precise. And then obviously in a self-custodial setup, you do have control over your keys, but at the same time, depending on the sophistication of the user, you also can be exposed to some of the more adverse things like spoofing, phishing, etc. You can get like a malicious transaction that you sign, and then all of the assets are gone from your wallet. And then the other element is, yes, you do get a much better LTV. So, we're going up almost at 80% on Morpho. So you're getting 80% of your collateralized asset in stablecoins, but then your rates are also fluctuating, so they're not fixed. So as long as the loan keeps getting filled, some people say, well, actually, I'm quite comfortable lending out against Bitcoin at this rate, and then if it doesn't get filled, the rate needs to get higher, right? Or if there's a oversupply of stables, then the rate goes lower. So you're not really sure what you're getting. However, we've seen this in DeFi, that the markets tend to find the most efficient and effective way of settling themselves. And that's pretty great. What you don't get in the self-custodial setup is what you would usually get with a credit desk is you don't get margining, right? In case there's a fluctuation and the price, you just get liquidated, right? And then the asset is gone. That can be counterbalanced with the fact that the LTV was not as aggressive as with credit desks, but credit desks give you some, an advanced margin call, and then still try to, either give you an option to either top up the collateral or repay the loan. So these are the two options, effectively, that you have. So either with a centralized player or fully self-custodial, I would say.
Okay, a centralized exchange or fully self-custodial into a DeFi service. But we've been asked another question. But before I do, since Pavel, you brought up the question of stablecoins, the stablecoins are obviously an integral part of this whole area. But is there any sense in which lending stablecoins is a totally separate business which can be abstracted from the cryptocurrency markets?
So the way that the market has been built up on DeFi is that you effectively match. It's always been peer-to-peer, right? So you effectively match the two sides. Same thing with trading, same thing with borrow lending, where you go like, okay, I have this asset and I want to borrow stables. And then on the other side, you have, well, actually I have stables and I'm looking for yield. How can I get that yield on my stablecoin? Potentially I can give it to somebody as a liquidity, right? And that person will pay me X for borrowing that liquidity, right? And that is the most common use case that we see in DeFi.
So you're not yet seeing stablecoins being used for trading strategies in, say, tokenized securities, which is the burden of the question which one of our audience members has asked. They say, on lending, is there a market today for lending tokenized stocks, creating a market for leverage in on-chain tokenization? We're talking here, I guess, about a convergence between all these forms of crypto assets, stablecoins, tokenized stocks and bonds, and cryptocurrencies themselves.
Yes. I mean, I can attest to this. This year has been fascinating because, yes, we are right at the beginning from the traditional finance sort of space of understanding this. Obviously, this has been been coming for a while, and I think Artemiy mentioned hyperliquid being a hugely interesting space. But as you start looking at lending of stablecoins, and you're getting some of the largest groups getting the stablecoin licenses, being able to generate yield similar to money market funds, but tokenized money being on there, and then looking at vaults. So you're looking at these DeFi vaults. This is going to be a huge part of the ecosystem as some of the largest banks, OTC desks and so on, start understanding that as you are tokenizing equities, bonds, real estate, infrastructure, tokenizing everything, you have a massive opportunity by putting these into smart contracts, custody structures. You effectively have huge product innovation coming, cross-collateralization coming, and innovation is going to be massive. And the larger banks, the largest groups are certainly looking at this. Some are experimenting and doing things. This is coming.
Yeah, let me add, equity market capitalization is around $127 trillion, which is not small. As fiduciaries, to the extent that those tokens, and they're coming online very quickly, to the extent there's the same or sufficient liquidity as a fiduciary, I'm compelled to use the tokenized version because it allows for me to risk manage my book 24/7. So when Trump invades Venezuela on a Friday night, I would wish I had my hands in those tokenized equities so that I could risk manage them. So this is an inevitability, and obviously lending will follow. The fact is right now that it's early. What else is going to really come into play as we move into these 24/7 markets is intraday yield. And people are going to have to start asking themselves, do I use a stable coin or do I want to use a money market fund? The stable coin pays interest to somebody else. The money market fund pays interest to me. And to the extent that I can capture that interest to the minute, to the second, as you start looking at size, I think that's going to come into focus. And so we're literally on the precipice of changing the entirety of market structure, from trading to borrowing to lending. SEC just put out an announcement rescinding Reg NMS. That will open up the gateway for decentralized equity trading, borrow, lend, etc. So watch this space. It's happening faster than you think.
I mean, if I just continue that, sorry, it's this area is just fascinating at the moment. You know, you've now got everything coming on chains. You know, you mentioned the SEC, Paul Atkins. We want to bring all financial markets on chain in 2 years. That's on crypto blockchains. You suddenly see the DTCC pilot of tokenizing equities of Stab, four and some a bit quadrillion in transaction volume. I know it's a kind of a bolt on to what they're doing and how they're going about it, but the New York Stock Exchange, NASDAQ, all of this coming in. And to Chris's point perfectly, what are you doing? You're collapsing inefficiencies. And that suddenly, you know, stablecoin, money market fund, you collapse the inefficiency second, minute, hour, whatever you want from the yield. So,
Well, it occurs to me, Ray, we're not comparing like with like here. You know, the DTCC initiative would be a digital version of the existing stock. It would be interchangeable, fully fungible with it. The tokenized stocks, which are, remember, the audience is talking about here, are not exactly the same thing. You're buying some stock, sticking it in custody, and then issuing a token against it. So your real risk as a holder of that asset is against the issuer of that token, not the underlying corporate issuer. So there is a complexity creeping in here as these markets integrate and converge with each other of trying to judge the different risks, I guess. Am I right to think like that?
No,
yeah,
I disagree. I think the digital twin model is going to die a fast death. That makes no sense. Why? What's the point? Why do you want to pay for fiat custody, fiat fees? No, it makes no sense. Canonical tokenized equities are the future. Full stop.
100%. They're trying to effectively replicate the old system with a bit of a bolt-on of new technology. This will transition. You just have two-step feet on both cams at the moment, but they're both going to go into effectively where, you know, the efficiencies are strongest.
Mm-hmm. Okay, well, we're about halfway through our time now, and risk has just come up a moment ago, but it's come up a number of times during the course of this conversation. So maybe now is a good time to start talking about that. But before we turn to it, I'd just like to put to you a question from Boris, who is a member of the audience, who's asked this question: is 24/7 really a good solution in time? Because we're talking about one of the things that is converging here is around the clock trading. Is 24/7 a really good solution in times of low liquidity, like late night on a Saturday? You can manipulate prices and do a lot of damage. Markets are working well with high liquidity, and it's doubtful this is the case with 24/7. Boris's argument being that liquidity isn't necessarily there at awkward times, and so you can take advantage of that as a trader. Is that a fair criticism?
I don't think so. Natural markets are 24/7. And to date, what's held back those natural state of markets? It's our technology. And yes, humans go to sleep, and when humans tend to be awake, that's when liquidity tends to form. But they've also haven't had access to markets during, evenings and weekends and holidays. We do in crypto. And by the way, guys, wake up in a couple of years, there's going to be very little human trading. It's all going to be based on AI agents. We're already seeing them proliferate, and the agents are excellent at optimization. They don't go to sleep, and I think they're going to be able to keep up with the natural state of markets, which is 24/7.
Okay,
I
well,
would agree.
yeah,
I would agree
okay.
with Chris on this one. I think everything that Franklin Templeton has done around Benji and the way that it's structured and the continuous yield, that is effectively the future. And I think old issuance will go away, right? And you see that the way that Alpaca, for example, has geared up their infra to serve X stocks, the way that Ondo is managing 245 with their just-in-time liquidity, it's all going in the direction of 247 markets. And then I mean, you have to be able to play during those markets, and then
Yeah, there's always
again, the
somebody
market will
awake.
decide.
There's always somebody awake somewhere in the world.
Just look at Hyperliquid. Hyperliquid is a phenomenal example of how somebody mentioned Venezuela outside of market hours. Somebody's mentioned, you just have to look at Iran, usually outside of market hours. Why is Hyperliquid in its, I think it's been around 10, 11 months. It's doing, give or take, more trading volume than the London Stock Exchange. This is a decentralized exchange. Perpetual futures. Effectively got the funding rate, long going to the short. Why are you doing this? Hedging. Hedge funds are hedging. Banks are hedging outside of markets because the world doesn't stop when the market hours stop. And this is why it's a natural progression. And I think it was Chris saying, the agentic economy, that is an exponential growth that we are starting to see. And that agentic economy with the agents that are trading 24/7, they will be hedging, they will be buying long, short, and everything else in between. And they will be doing this on these rails.
Okay, there's your answer, Boris. Let's talk about risk. Wendy, perhaps we could have the second answer, which the audience gave. And again, we asked everybody who registered what they thought was the most worrying risk. And 2 out of 5 of you mentioned cyber attacks, which I took to mean assets on loan getting stolen by hackers. 1 in 5 of you is worrying about assets on loan falling in value. So there's a catastrophic fall in value, but you can't do anything about it because the asset's on loan. But I see also in these answers a lot of concern about service providers falling down on the job, or even falling over altogether. And if we add up the registrants who are concerned about the failure of a platform or the service provider, or just failing to segregate assets properly, we get to something like a third of respondents. So there is a concern here about the quality of the service provider, a question of trust almost. Artemiy, you've been very quiet for a while, but you're also providing a yield infrastructure. What do you say to those members of our audience who are concerned about services failing or service providers falling over, or maybe talk about what sort of criteria people should use to assess a service provider?
Yeah, thanks, Dominic. First of all, here talking about risks and service providers, we need to separate like self-custodial setup when you work there directly with like yield platform, whether it's like staking provider or DeFi protocol, and when you use like custodial setup. When it comes to working directly with the staking provider, it's the beautiful thing about staking. It's non-custodial, and if a service provider fails, your funds still stays with you because you maintain custody. So for the majority of proof of stake protocols, the staking is non-custodial, and the client maintains custody over assets. For Ethereum, the biggest proof of stake network, it's slightly different, but reputable staking providers still provide clients with withdrawal keys and voluntary exit messages. So basically, non-custodial staking. In non-custodial staking, you are safe with keeping your money in case of counterparty failover. With custodial intermediary, it's a different story, but you should it depends on your assessment of your custodial partner. you need to select and do like risk assessment of a custody and work with with guys like AMINA Bank and like big custodial players are basically insured and safe bet for your assets if you want to hold your assets in the custody or you need to do it via whatever reasons, you need to assess like your custodial counterparty in details.
How real is this risk, which the audience has signaled about cyber attacks? How real is that risk of cyber attacks leading to the loss of your assets that are staked or on loan?
Oh, it's too real. Like over the last couple of months, it exploded. Yeah, it's been like the biggest month, April and April specifically, May. Like we had in April, as far as I remember, we have almost the number of cyber attacks was equal to the number of days in the month. It was like 25 plus cyber attacks with 800 million being stolen. So I agree with the audience. It is the biggest like threat right now, not like the counterparty failure, not the slashing, like
Okay, and are those assets gone? Were they recoverable?
like some of them gone, some of them recoverable, depending on the case. We had a big case with Layer Zero, KelpDAO, and Aave, and it was almost 300 million. And then the beautiful initiative of DeFi United came into place, and now the markets are operating. So yeah, it depends on the case. In some of the cases, of course, these are non-recoverable, but in some, luckily, they are.
So if I could chime in, there's good news and there's bad news. The bad news is that the North Koreans are ravaging our startups. They're ravaging our industry. I think in the month of April, they stole $600 million. That's not good, particularly when you have a state actor maneuvering against a young industry. That's the bad news. The other bad news is that AI tools are finding vulnerabilities, and it's putting people on notice. Look what's happening with Mythos right now.
Mhm.
That said, the good news is that those vulnerabilities are quickly being discovered and eliminated. And as we start applying these AI tools, our various protocols are curing them. And it's really making the foundation much more strong. That's wonderful. Now, going forward, once we clear up those coding vulnerabilities, there's still going to be a lot of vectors, and I think it's going to get worse with social engineering, which is a lot of the North Koreans' best choice of hacking. That said, there are also tools that are coming online, proof of humanity, et cetera, that will help us mitigate some of those social engineering issues. So it's just AI, it's going to be this AI cat and mouse game. Fundamentally, I think AI will make us much stronger. I also, we've been working closely with the administration. There are policy things that need to be addressed. It's just intolerable to have state actors maneuvering against startups. I think that's coming together. I've been personally a big advocate of using the constitutional right, which allows private citizens to go and help recover. We'll see if that comes to pass, but I think medium term, I think we're kind of at a low point right now, and I think it's going to get better as AI tools come online.
I was
Maybe,
surprised. Do you want to add something, Pavel? Go ahead.
yeah. I mean, maybe to chime in to what Artemiy and Chris have said, I think definitely we're seeing AI as almost equally correlated to the cyber attacks. So the rise of AI, it's simply because people are just getting better at, deciphering the way that some of the smart contracts have been put together. What does the info looks like, etc. I think it's also, post hack is definitely something that we need to improve on in terms of processes. But also, I think this is for all of us who are building in this space. It's incredibly important, to take cybersecurity risks as something incredibly serious, right? Making sure that you have, if you are looking to scale and you are looking to have, to grow whatever you're building into a blue chip company or protocol, you have to take these things seriously, right? And you have to take it seriously on the tech side, on the people side, making sure that you as protected as possible. And that's just, I think it's an industry-wide effort.
Very few people are worried about slashing, though. It's come up a number of times in the course of our conversation here. So clearly our audience doesn't feel that the risk of these penalties for bad behavior are that real or that big. Yet I guess these slashing penalties are being automated now. I also wonder sometimes whether they actually work as intended. Do they actually incentivize good behavior and deter bad behavior? I mean, are people underestimating the risk of slashing? Ray, Chris, do you lie awake worrying about it?
I wouldn't say so. I mean, from our side, use experience validators. And I think, if you're doing that, diversify validator exposure, use experience validators, and behave honestly, continue uptime. Probably not one of my personal areas of the most expertise, so I'll stop there and defer.
Yeah, it's funny. Anytime there's a new technology, and you can actually trace history back to the steam engine. And back in the days when the steam engine first came out, people were scared to death of it because every now and then a steam engine would blow up and kill everyone around it. And so this perception of the risk for new technologies is often much higher than the actual risk itself. That's exactly what we're encountering today with staking. And frankly, that's why it's such a lucrative environment for insurance, which helps close that gap. And insurance, including Munich Re, one of the companies that they ended up buying, came out of was one of the fundamental products was the steam engine. So insurance will close that gap. But when you look at the numbers, the actual risk against the perception of the risk is night and day. There are even policies now where you can insure the yield itself. So it's not something that keeps me awake at night. If you seek to do it yourself, and that's the beautiful thing about DeFi and beautiful thing about staking, you can have 32 ETH and you can, figure it out and go about it yourself. Maybe you're taking a little bit more risks, or you can outsource that to a trusted intermediary in an institution where that risk is diminished. And yes, you pay for that. So what I love about crypto is that you can go in either direction.
Mm-hmm. Let's talk, finally, we've got about 10 minutes left. Let's talk about how these risks can be mitigated. So Wendy, perhaps you could show us our third and final slide, which depicts what the audience thought was the most valuable risk mitigant from their point of view. Here's what they said. To my way of thinking, what's really striking here is the emphasis on custody. When I add up the number of registrants who emphasize custody technologies, custody processes and procedures, the value of having an independent custodian, using your own wallet, or indeed having insurance, which you, Chris, have just mentioned. We've got a clear majority of respondents here, 66%, worrying in different ways about custody. Pavel, this is your one of your key selling points, I guess. How can assets be held in custody while being staked and lent? And we'll come back to the second most important thing, counterparty due diligence, and ask ourselves whether people mean custodian or who is your counterparty here. But tell us about custody protections to mitigate the risks associated with this industry.
Right. I think it's important to understand if you are going in the custodial, towards a custodial setup, whether you work with, let's say, digital asset centralized entity, what does that setup looks like? Try to potentially understand if there is a certain reliance model on, some of the leading players in the space. So we know for a fact that Binance uses their own setup, for example, right? Fireblocks, I think, has about 60-70% of the market share. Zodia, Taurus, these are some of the major players in the space. So obviously these colleagues are fanatical when it comes to safety and security. So that's an incredibly important element. And then also trying to understand, what does the safety and security protocols look like. Then obviously if you are in a self-custodial setup, then just making sure that you follow specific hygiene processes, right? Continuously look at what type of permissions you gave through interacting with different smart contracts. Revoke.cache, I think, is a really good tool for you to check. If you've been connecting to a bunch of applications, seeing what's out there, participating in lending, borrowing, looping, what have you, you may have interacted with a bunch of different smart contracts. Those permissions are still there, right? Because once you connect and you say, yes, I want to interact with the smart contract, you open up a permission. So kind of going into revoke.cache or some of the other tools and then revoking that permission, making sure that you stay safe. And then again, for power users of self-custody wallet setups, I cannot not recommend some of our friends and frenemies and competitors, right? Anchorage has a tremendous setup with Porto Wallet. It's institutional grade. It's a paid service. Same with Braun. Key recovery, all of that stuff is there. They're just, really, really, really good fanatical guys that are obsessive about self-custody. So, but they're doing it at that incredibly high safety and security standard level, which I think is as we progress will become almost like the norm, right? You just cannot ship products that are just not up to that standard.
I think if I just complement that slightly on the standards, so risk and trust and risks, they are one and the same at this stage of the game. And I think this goes right back to, I think, one of your first couple of questions on, is this appropriate for everyone? What is the mandate? What's the risk tolerance? We do a very large number of we have a number of large due diligences done on us as an issuer. And it's the operational side, which is where the most interest is. So from custody, this is all institutionalizing. And you cannot do business now unless you have, what's your stock 1, stock 2, what's your sort of, what controls do you have? Are they at the highest enough standard? Do you have an independent administrator, when you are moving assets from a custody? Do you have bankruptcy remote structure? Do you have independent audit? All of these things are now, they're very, this is very cookie cutter in traditional finance because it's been around for so long. But now it's moving here, and the same rigorous standards, just on a slightly new tech stack, are coming in. And it's rigorous standards, and we're seeing, you mentioned Zodia, who have now been acquired back into the fold with Standard Chartered, BitGo, Coinbase, the old names of Cassis to State Street to BNY. Everybody's coming into this in one shape. And again, it's institutional standards that are being required by those who are allocating. If you are looking at that side, then this is self-custody, same thing. You've got to have the highest standards.
Chris, can I tempt you to give us a view on the second most important risk mitigant which people have named here, namely counterparty due diligence? Now, it strikes us not necessarily a very simple matter, but a lot is going to depend on how you're actually doing this as to who your counterparty is. It could be an exchange, could be the infrastructure, could be an app, could even be the protocol itself, I guess, but it would also be your custodian, whether that's a bank or a non-bank. And again, there's I guess a compliance risk here too. You could find yourself inadvertently dealing with a sanctioned crypto exchange. So what does due diligence actually mean for our audience in this context? Who should they be doing this due diligence on?
Counterparty risk has been a risk that's plagued markets, for as long as I can remember. I was at Lehman, remember, and I was there when I saw one of the largest counterparty defaults in the history of Wall Street. We've also had counterparty risks across crypto from the beginning. Startups have come out, tried to get over their skis a little bit, volatile asset. So particularly in the borrow lend, when you're working with a counterparty, a centralized counterparty, having very, very robust counterparty due diligence, credit analysis, massively important. And it's very difficult, I think, for a lot of retail users to do. And institutions have, grown up processes, but they're imperfect. And it's something that, as people are looking for trusted partners, has to be a big part of their underwriting, because you cannot mess with this. It gets more complex when you get into DeFi, because if you're accessing a protocol directly, You can go directly into that protocol. You can go in through a front end. You can go in through an intermediary. There are so many different flavors that investors need to understand where the counterparty risk lies. What we've seen out of the gate is for many DeFi protocols, because they're trustless and permissionless, they over collateralize. And they over collateralize to try to mitigate as much risk as possible. We've seen issues even across DeFi where that counterparty risk mitigation didn't really work and trades were torn up. We had this famous issue around 1010, major stress in our space. So it's very important that if you're going to go directly into DeFi or into DeFi lending, you really understand the risks, the waterfalls on the counterparty side. Now vis-a-vis transacting with sanctioned counterparties, the beauty of DeFi is that it's instantaneously global, and that anyone in the world can access it with as long as you have access to the internet. So guess what? Sanctioned entities can be theoretically your counterparty. The good news is that for sophisticated institutions, we can avail ourselves. We can use very sophisticated analytics to understand who's on the other side of the trade. But if you're retail and you're entering into a swap and you're not checking, there is a possibility. Now, based on our analysis, when you really dig into the pools, very, very low concentrations of bad guys tend to hang out in those pools, but they are there, and it is a risk.
Reminds me of that old internet joke from the 1990s that on the internet nobody knows you're a dog. We've had a question from Ben at BNY, and it is as follows. Do you feel the current anonymous vault offering will fade into a more retail offering with institutional lending moving into the TradFi space? Who understands that question? Do you know what Ben's getting at here?
I'm assuming he's talking about when you've got basically vaults being created to effectively have smart contracts generate yield on tokenized assets. At the moment, there is a level of anonymity. And again, this kind of alludes to Chris's point. There's a certain amount of anonymity, but then this is a transparent asset class. So it only goes so far. I think there will always be a space in retail for curated vault-like products to generate yield on the tokenized products that they have. Institutions, though, will require transparency for AML, for KYC. So, for example, when we're looking at things, we will be tracking transactions, a number of transactions back. And if it happens to have been touched through a tumbler, so there has been, or if some nefarious bad actor, whether it is the Lazarus group, well, you know what? We're not going to be interacting with that because suddenly you're on the wrong side of the regulator, and that's really not where anybody would want to be. I'd say anonymous becomes very retail DeFi, but institutions will need the on-chain analytics to effectively be sound and have that traditional finance level of governance. It's traditional finance requires this. If you want to play in the big boys, I don't know the number. I think Chris said about equity capital markets, and he said 120, 127
trillion.
Yeah, you're talking vast sums. If you want to be at the table there, you need governance and you need the highest, most rigorous standards, and that's where it will bifurcate.
So I think you're agreeing with Ben that actually it is going to become a retail-only proposition, the anonymous vault. We're into our last 2 minutes now, so perhaps we could sort of wrap this up. There's dozens of things we could continue to talk about, which we don't have time to do. And I thought about this myself. I thought of nearly 50 questions I would love the answer to. And we haven't got through more than a tenth of those. So perhaps I could ask each of you just to give me a final thought. We've talked a lot about the opportunity and about the risk here. What would be the advice you gave to members of our audience who are looking at doing this about where to strike the balance between the risk and the reward of staking and lending? What are the 2 or 3 things you'd ask them to look at on the risk side in particular, and what they should look out for on the opportunity side? Just some very brief takeaways for everybody listening to carry away with them. Artemiy, perhaps you could answer that first.
Yeah, first of all, Dominic, thanks for moderating today. You did great. I think everyone enjoyed our
Being moderator is very
conversation.
easy, Artemiy. You don't
No,
have
not
to.
at all. Not at all. It's actually pretty hard. Being a good moderator requires some effort. So thank you. Like my major takeaways from this conversation and what I would like to share is actually to zoom out from this risk reward framework, right? What is most important is the due diligence and understanding of the risks in the first place, due diligence of your strategy, of your counterparty, of your goals. It's like the main thing actually. It's important, and you need to keep in mind that some risks are overestimated, like we discussed slashing, and we I think had a consensus on it is being overestimated, but some are underestimated. So I think like smart contract risks are too generalized, and there are some off-chain risks which needs to be also taken into your due diligence profile. And yeah, select reputable like partners and do the due diligence, and then think about rewards and so on and so forth. I think the foundation is the most important thing. Thank you.
Okay, thanks, Artemiy. Chris,
Yep.
there was an observation by a member of the audience when they registered for the thing saying, what I really need to do is understand what the risks here are so that I can work out what the worst ones are and set about mitigating them. Is that Artemiy just explained that you have to do serious thinking, serious work, serious due diligence to work out what those risks are and decide which ones. Exactly that point. Some are exaggerated, some are not. What's the advice you'd give to members of the audience as they set about their strategy for generating yield on their cryptocurrency holdings?
I think that you don't want to leave money on the table. The yield that's available to industry participants, it's lucrative. From through a real yield lens, I think you can have some beautiful returns, and it just doesn't make sense to leave that yield on the table if you're an investor. The question is do you go about it yourself and you have every ability to in DeFi, underwrite those risks, understand them front to back, or outsource it to a provider for cost, do that analysis, and make sure you know where the accountability is. For DeFi, that accountability may be with yourself. And if you choose a third party, then you can make sure that you understand how that third party is to be held accountable, particularly through an institutional lens.
Thanks, Chris. Ray, I can see you've been very excited throughout this conversation about the convergence between TradFi and DeFi. These worlds are coming together, and if you're to operate successfully inside them, you need to understand where they've come from, where they're going, how they're going to interoperate. Because we're going to be living with a transition from the world that was to the world that will be for quite a long time, aren't we? What's your advice to members of our audience as to how to approach building their own strategy?
I would say save yourself a whole lot of time if you are coming at this relatively fresh. Speak to the people on this call, speak to people who have been in the asset class for some time, and it'll just save you going down rabbit holes. It'll basically point you at least in the right direction, and then do the due diligence as this asset class institutionalizes.
Thanks, Ray. A last word from you, Pavel, as our sponsor today. This is your opportunity to tell the 2/3 of our audience who are actually come to this webinar because they're very interested to find out how not to leave money on the table, as Chris says. What's your top tips to them as to how to build an effective high yield strategy?
I would say that we at AMINA publish incredible research, and it's all available for folks to read. We go to events, we give interviews, so there's plenty of information out there. I think in order for you to participate in this asset classes, you have to understand it better. And then once you understand it better, as everybody has confirmed on this during this webinar, you feel more comfortable with it as an asset class. And then we see this with some of our clients as well, where they go like, okay, I would like to purchase my first Bitcoin. And then from Bitcoin, I go, okay, well, maybe it should be a bit of BTC and then a tiny little bit of ETH. Okay, I have both. Now what? Oh, I actually can stake ETH. So it's a progression, right? And the deeper you dive, I think, Ray, Chris have been talking about hyperliquid. That's obviously, top tier, high performance, Formula One type scenario. But I think just getting comfortable, getting familiar with the very basics of the asset class, and then slowly, growing your knowledge and being a tiny little bit more open to new opportunities, I think is the right way to go. But you have to do it based on research, right?
Well, I think it's a great place to stop. I think you've all said in different ways, don't skimp on the work out what matters and what doesn't matter, and do your research, and you will get rewards. But our time is up. We must leave this conversation there, even though that could have gone on for some time. I'd like to thank our panelists, Pavel Jakovlev from AMINA Bank, Artemiy Parshakov from P2P.org, Ray Dillet from Bitwise, and Chris Perkins from 250 Digital Asset Management. And thank you also to you, our audience, for completing our poll and then for your questions and comments during the course of the webinar. And our thanks also, of course, to AMINA Bank for sponsoring the discussion. Here at Future of Finance, our next event is as soon as tomorrow. We're hosting another webinar, this time about tokenized funds. It starts not at 2 p.m., but at 3 p.m. London time tomorrow, Wednesday, 17th of June. It's not quite too late to register if you'd like to attend that. But with that, it's all from us, and goodbye from the five of us. Goodbye.